Welcome to The Explainer. Today, we're diving into a market that's sending some seriously mixed signals. You've got assets hitting all-time highs over here and massive amounts of money being pulled out over there. So what gives?
Okay, let's break this down. In one corner, you've got the bull case, right? Soaring asset prices, sky-high investor confidence, the works. But in the other corner, the bears are growling louder, pointing to some pretty clear signs of anxiety and major risks on the horizon. How can both of these things be true at the same time? Let's unpack it. First up, let's talk about gold, the traditional safe haven asset. Well, it has been on an absolute tear, just smashing through its previous records, and honestly, leaving a lot of analysts pretty stunned. Yeah, this year, gold just surged to a new all-time high, climbing past $2,420 an ounce. And look, this wasn't just some small jump. It was a huge, clear signal that investors are looking for safety with all the economic and geopolitical uncertainty out there. So the big question is, what's behind this? Well, this rally is definitely not random. It's really being fueled by three key things. First, pretty much everyone expects the US to cut interest rates. Second, central banks all over the world are just buying up gold like crazy. And third, you have those rising geopolitical tensions. Put it all together, and gold bullion is on pace for its best year since, get this, 1979. Now, here's where it gets really interesting. Gold's historic rise has brought back a popular and sometimes pretty controversial theory about where all this big money might be headed next. It's one of the biggest what-ifs of this whole market cycle. As gold hits its peak, are we finally seeing the start of a great rotation where investors begin swapping their gold for its digital cousin, Bitcoin? So first, let's just be clear on what we mean by capital rotation. In the simplest terms, it's just the movement of a whole lot of money from one asset class, like gold, into another one, like Bitcoin, as investors go hunting for higher returns or maybe a different kind of safety. Now, to try and test this theory, one analyst built a simple model. It looks at the 180-day moving average for each asset, which is really just a way to smooth out the price and see the real trend. As you can see, a positive signal for this rotation pops up when Bitcoin's price is trending up while gold's is trending down. Now, it's not a crystal ball, but it has highlighted some pretty interesting patterns in the past. All right, let's shift gears over to the stock market, because this is where the whole theme of contradiction gets even more intense. Investors seem incredibly optimistic about 2026, but there are some really serious risks lurking just beneath the surface.
There are 5 key areas of concern we really need to unpack. First, valuations are just through the roof, especially in tech, which makes you wonder how sustainable that is. Second, are the profit forecasts we're seeing realistic, or are they a little too optimistic? Third, we're seeing a move away from the AI stocks that have been driving this whole market. Fourth, a huge slice of the market's gains are coming from just a handful of giant companies. That's a big concentration risk. And finally, investors are so bullish they have very little cash on the side, which could be a real problem if things turn south. And this really gets to the heart of the valuation problem. The talk of a bubble, especially around AI and big tech, is just getting louder and louder. In fact, some key S&P 500 metrics are now actually higher than they were right before the dot-com crash in 2000. That is a pretty sobering thought. This brings us to the final and maybe the most confusing piece of the whole puzzle, investor sentiment. Because right now, despite all those risks we just talked about, confidence is, well, it's completely off the charts. Just take a look at this. According to a recent Bank of America survey, the amount of cash investors are holding has cratered to a record low of just 3.3%. That shows a massive appetite for risk. It's like almost everyone is going all in on stocks and commodities. But here's the twist. At the exact same time that investors are so confident in traditional markets, we're seeing a huge exodus from digital assets. We're talking nearly $1 billion was pulled out in just 1 week. And the story gets even more curious when you look at where this is happening. This whole wave of negativity seems to be almost entirely an American thing. While US investors pulled out almost $1 billion, investors in Canada and Germany were actually buying. So you have to ask yourself, what is driving such a huge difference in opinion? So what does this all mean? Well, with extreme confidence in stocks clashing with some pretty significant underlying risks, and with bullish feelings in one region totally contradicting bearish moves in another, 2026 is really shaping up to be a year of some very tough choices for investors. If you found this video helpful, be sure to smash that like button and subscribe so you don't miss your next daily edge. More news in our Telegram channel and the first comment. See you next time.